Let's talk to Nicole Elliott. Nicole is a private investor and technical analyst. Very good morning to you, Nicole.
Hello, Nick.
Okay, we're going to talk about the yield curve. Let's kick off with 3 slides. The first one, we've got the US 10-year money. This is the yield. What are the charts telling you?
Well, I've been looking at this one very closely since Sunday, actually, because it's only 4 times a year that I get to play with quarterly charts.
Right.
And so as it was the 1st of October on Monday, I thought best do my homework and get ready. And what caught my eye on this one is that we actually settled at the end of September above the 3% level. Now, there's nothing magic about the number 3, but it is the highest close since 2011, quarterly close. It is the highest. It's above a couple of Fibonacci retracement resistance levels, which are all those red ones. You've got a host of them. It's above clearly above for the third quarter in a row, above that descending trend line that starts from 1988. So that's a 30-year trend line that's held. You look at that carefully and try to work out what you're going to do. And then today, well, overnight really, the momentum built by that strong close, people are going, is this really going to happen? Well, it was fueled by an interview on America's public broadcasting service, radio, TV, yesterday with Jerome Powell, the head of the Federal Reserve. And I quote, "We're a long way from neutral."
Right.
Now, he admitted that we no longer need the extremely accommodative interest rates that we needed when the economy was weaker.
Yep.
He said we don't need those anymore. Well, I think he's made his point quite clearly with his moves so far since he took over. My idea here is that there might be a bit more to go in the States, but not that much. I've got plenty of horizontal resistance levels between here and 3.9%. So currently we're just under 3.25. We've moved up from the record low, which was just under 1.5. So we've doubled interest rates here. This is not an insignificant move at all that we've seen over the last year and a half.
Understood.
But be careful. Don't think that everything else is marching to this one's tune. It's not. And the yield curve still is very, very flat in the States, which is not a healthy sign. So my worry is that Mr. Powell and his team will continue and take rates too far. And he even mentioned this possibility in yesterday's interview. He said, yes, we might actually go beyond the neutral point. Well, I'd say that's a very dangerous game to play. Very, very dangerous indeed. And I would not go along with this move of his at all.
Understood. Okay, let's move on then to the UK. Now, this is 2-year money on the yield, a quarterly chart. Is this breaking up and out?
I don't think so. And even if it does go a little bit above that diagonal line, I'm really neither here nor there. I'm not bothered. There's not much difference between nothing and 1%. My point here is why on earth tinker around with the bank rate when you're facing Brexit? Just leave well enough alone. And, your choice here on 2-year paper, as I say, is between sort of nothing and 1%, which we've been in since 2011. So just leave it at that, except that's the kind of neutral rate for now in Britain.
Understood. Okay, let's wrap up with Italy, the 10-year money. Obviously making the headlines this week. Is this scaring the pants off the market?
Well, we looked at this one a fortnight ago, Nick, and pointing out these triangles and things like that. What's happened this week is that we've broken above the most recent triangle.
Which the textbooks said that we should break out in the direction of the previous trend, didn't we?
Correct, and we did some measured targets,
Yeah.
and it's quite a tall triangle, that one, so this has got a way to go, and I think it will go further. But that is not really what I'm so worried about. We do have a kind of watershed level at 3.5%, so keep your eye on it. Tuesday we got up to 3.44%, so we're nearly there. But my point is, between 1999 and 2011, most of the time, this particular little beastie yielded between 3.5% and 6.5%. Then we had this crisis in 2011 when the whole of the Eurozone bond market looked as if it was going to implode one way or another. And then since then it traded down to that record low of 1.04. So a bit like a British one, isn't it? But this is 10-year. Now here at 3.44, 3.5, my question is, are we moving into a new kind of trading band, or will we peak here and go and keep within the 1.5 to 3.5% band? That is the key. My fear is that we're not. We're going to move higher, and sort of 3.5 to 6% is going to be your norm here, not the odd bit, right? Now, the problem with this is that other than the ECB, which holds way too much of this paper, the next biggest holders are the Italian banks themselves.
Yeah.
This is part of their capital requirements, and they choose to do this. Now, this year, roughly, this paper has lost approximately 15% of face value.
Right.
So that means that your reserves need topping up. How are you going to top them up? Are you going to ask shareholders for more money?
Yep.
Do you think they're going to put their hands in their pockets and hand over fistfuls? My guess is that the answer will be no. And so then you've got a double whammy. You've got the ECB holding paper that you can't sell. You've got the banks needing more capital, which they can't get hold of. So the issue on the yield here is actually, in my opinion, secondary. It's a secondary issue. The core here is that this paper, relative to its European peers, is so out of favour, it's just not funny. And they're so beyond the Growth and Stability Pact, which stipulates 3% annual deficit and debt of 60% of GDP. I mean, they're at 132%. And it's 2.1 trillion euros worth. I mean, this is big, big amounts. And people are voting with their feet and saying, do you know what? I'd rather really not be in this market at all. So you become a sort of Argentina or something like that.
Well, on that joyous note, Nicole, thank you very much indeed.